Success in Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome back to the Financial Survival Network. It's Kerry, Lutz, and so much going on in the world right now. Central banks, Greece, Switzerland, just spin the globe around and stick a pin in it. And there's bound to be something happening. And here to discuss it is Bill Holter of milesfranklin.com. Make sure you go over there and subscribe to his daily missive. Bill, it's been a while, and Happy New Year. And how are you?
I'm well. Thanks for having me on, Kerry.
Hey, always a pleasure. So recap for the various things taking place in the world that it's almost impossible to keep up with it,
Well, the news cycle is crazy. I mean, the news cycle, we probably get as much news now in a week's time as we got, say, 15, 20 years ago in 6 months or a year's time.
Yeah.
I mean, it's amazing. It's amazing that so much news comes out and people are so numbed down that there's very little reaction.
Mm-hmm. Yeah.
The big news, I guess, since the beginning of the year, the biggest news was, in my opinion, the reset started, and that was with the Swiss backing away from the 120 euro peg. That basically was the Swiss saying, we're not going to underwrite the euro anymore. And, of course, immediately you had a 30% move between the Swiss franc and the euro. That, of course, bankrupted some trading houses. And interestingly enough, the following day or maybe 2 days later, the Swiss announced that they are opening a renminbi hub in Zurich. So they are going to trade currency directly with and for China. Mm-hmm. So I wrote a piece called "The Neutral Swiss Are Changing Sides," and that certainly has got to be a blow to the West, because now you've got another big Western financial center that's turning away from New York and turning toward Beijing.
Yeah. Yep. And when they broke the peg, they didn't tell anybody about it. None of the powers that be. None of the too big to fail banks. They were all kept in the dark about it, and
Kerry,
the losses were staggering.
If you notice, Christine Lagarde was on CNBC that day, mm-hmm. and they asked her if she knew about it, and she said no, she didn't. And she was a little bit huffy and a little bit irritated, and it did look like she didn't know. And she was talking about communication and coordination, and in this case, there was none. Mm-hmm. This was a complete blindside.
Oh yeah, yep. And you got to wonder what's going on there. But yeah, it looks like
the Swiss did what's best for the Swiss.
Mm-hmm.
Plain and simple. They just stopped playing the game.
Yeah, that they did.
The ramifications for gold is pretty big. The Swiss were rumored to be short gold, and if you look at a gold chart, almost to the day going back to 2011, that's when they announced the peg. Is when gold started going down. So it's very possible that the rumor that the Swiss had been shorting and were short gold, that very well could be true. And if it is true, now you've got a big buyer that needs to unwind a position.
Right. Yeah. So could be the beginning. Could definitely be the beginning.
Well, it certainly was a reset. Whether it's a system-wide and global reset, we don't know, but it's definitely a reset between the Swiss and the Europeans.
Mm-hmm. Well, they had lost, by some counts, several hundred billion euros, dollars, francs.
600 billion.
600 billion we're up to now?
Yes.
I heard 200 to 300 billion.
Yeah, no, that's not the loss. That's what they were holding.
Yeah.
Yeah, they were holding 600 billion. So if you take a 20% loss on 600 billion or
mm-hmm.
a 15% loss, you're up to 100 billion.
Yeah. So the loss I heard is somewhere 1 to 200 billion. And because it dropped so much that day, probably over 200 billion. And I seriously doubt that they were trying to hedge that loss if they had the opportunity to do it, because that would have signaled to everybody what they were doing, right?
Right. That's too much size to try to hedge.
Yeah, you just can't do it.
And had they done it privately on the OTC market, you would now hear of someone who's underwater.
Mm-hmm. So
I mean, you couldn't have like a Goldman Sachs or even a JP Morgan take a $50 or $100 billion hit and not hear about it.
Nope. Couldn't be done. So they were that was an unhedged loss, and they finally just decided to take their losses. That's pretty remarkable in itself, but they're not talking about their losses, are they?
Your first loss is your best loss.
Yeah.
Now, I was a broker for years, and if you carry a bad position and think the market's going to work you out of it, it never happens that way.
No.
It'll just keep going away, keep going and going. And I mean, with Europe announcing a QE, who's going to fund that? It was going to be expected that the Swiss National Bank fund that via their central bank, and they just clearly did not want more euros on their balance sheet.
Yeah, a real mess. And, well, the good news is that they won't have to worry so much about the Swiss minimum wage jacking it up to $25 an hour, right?
Well, yeah, I mean, their currency exploded.
Yeah, so their purchasing power went up. The bad news is that their companies, Nestle, Ciba, and all of the pharma companies, chocolate companies, are all going to take huge hits to their earnings, because most of their earnings are coming from the EU, and going to lead to some companies moving out of Switzerland for the purposes of earnings, because
it made some business models completely ineffective and unusable.
Right. Which, hey, it's the way it goes. But for the average Swiss citizen, it was a good thing. Too long in the making, and you just can't fight the market. Not when you're a small country like that. No country can really fight the market indefinitely, and that's just a foreshadowing of what's going to be happening all over the world, eventually to the U.S.
Yeah, it's Mother Nature at work.
Yeah, you can't fight the laws of economic reality indefinitely and expect a positive outcome. It just is impossible, right?
And that's what we're doing here in the U.S. We are completely fighting the laws of economic outcome.
Mm-hmm.
We're being told that, QE 1, 2, 3, increase the debt, 8 trillion, 9 trillion, whatever. It's all good. It's all good for growth. Well, no, it's not.
Yeah.
The economic reality is we're twice as much in debt today as we were 7 or 8 years ago. The Fed's balance sheet is 4 or 5 times larger than it was 6, 7 years ago. The laws of Mother Nature, the laws of economic reality say the piper's going to be paid, and we can't pay it. Our standard of living is going to collapse.
Mm-hmm. Yeah, well, there's nothing new here. You and I, Andy, so many of us have been telling you this for years, and yeah, we appear at times to be part of the stop clock society. Let's face it. It's all fun and games because it's not happening according to any timetable. But you know, and I know that eventually the economic realities absolutely have to assert themselves. And when they do, it's going to be extremely painful.
It'll be extremely painful, and it's going to be extremely quick when it does happen. I wrote a piece, I think it was yesterday or the day before, entitled Gaps. And I think that's what you're going to see.
Yeah.
I think you're going to see that in all sorts of markets. You're going to see gaps where asset prices move 20, 30, 50% overnight and more. I could envision seeing gold and silver more than double overnight versus currencies.
Yeah.
And the average, not just the average person, but no one is going to have a chance to change or fix their position during that gap period. So you're going to wake up, and all of a sudden your net worth is going to be different. You may be a winner, you may be a loser, but your net worth is going to change. Now, the part about being, you may be a loser, you may be a winner, that's a problem, because in the derivatives market, the OTC derivatives, you've got companies doing business with other companies, and for every trade, there's a winner and a loser. Now, if we have these gaps, which I believe it mathematically is a certainty at this point, if we have gaps, you're going to have some companies that are relegated to bankruptcy.
Oh, yeah.
They're going to be broke. And what does that make the winner? It makes the winner a loser because he's not going to get paid.
Counterparty risk.
Exactly. There's going to be counterparty risk anywhere and everywhere, and everything will freeze up because just like in 2008, except multiply it by some number, it's going to be much, much worse. Everything's going to freeze up, and nobody is going to want to trust anyone else to do business with.
Well, look, Bill, this is all things we've discussed, scenarios we've discussed, and it's quite obvious what's going to happen. All these contracts will have to be nullified because nobody's going to be able to afford to pay them. And they should have never been allowed to occur in the first place. But here we are, you know.
And that's going to leave the underlying positions naked, where those who thought they were hedged are not hedged. So it's going to leave the underlying positions naked with a winner and a loser, and now you're eating into the core positions themselves.
Oh yeah.
Speaking of CDS, credit default swaps, Greece is a really interesting story on that. I mean, they've got $300 or $350 billion of sovereign debt outstanding. I think their economy is, $240 billion, $250 billion.
Mm-hmm.
And their debt to GDP ratio is in the neighborhood of 175%, which is totally banana republic land. But these bonds are considered Tier 1 capital, and they're sitting on banks' balance sheets. They're sitting on the ECB balance sheet at par. Well,
Waiting to blow up.
They're trading at 30 cents on the dollar. But add one more thing to that. Add the credit default swaps. And credit default swaps are like, for speculators, it's like buying fire insurance on your next door neighbor's home.
And life insurance and having a gun to his head, right?
Right, exactly. The problem is, if there's only 300 or 350 billion in actual bonds, there's probably likely 10 times or more that amount of credit default swaps.
I know.
You're talking $3 to $5 trillion worth of credit default swaps.
Yeah, not a good situation by any stretch. You know, Bill, it's that old saying. I hate to make gun analogies, but it's always better to have a gun and not need it than to need a gun and not have it. It's always better to have gold and silver and not need it than to need gold and silver and not have it. And that's what it's going to come down to, because all this stuff blows up. What else are you going to be able to look to?
I agree 100%.
And we've been telling people this for years. It's not exactly a new revelation, is it?
No, it's not rocket science. It's pure common sense.
Yeah. And about those Greek credit default swaps. So they're going to figure out some way to mollify the Greeks now and kick this can down the road yet again, aren't they?
Can they really do that? Because if they actually do pull that off, now you're talking about the Spanish, the Italians, the Irish, the Portuguese. They're going to say, hey, you gave them a haircut, we want a haircut. Or you swapped their bonds, we want to swap our bonds.
Well,
the whole thing is about not calling a spade a spade. The whole thing is about keeping the fact that Greece is completely broke. They've already spent the money that they borrowed. They've spent all the money that they've been given to pay the debt service back. It's all gone. They are broke.
Right.
And the whole operation is about keeping that hush-hush and kicking the can down the road. And the reason why they have to kick the can down the road is because once this derivatives chain breaks, then it drags the rest of the West and it ends up in both London and New York.
Mm-hmm. Yeah.
And it exposes the fraud of the entire Western financial system, which obviously leads to our gold hoard and the fact that we don't have it.
Right. And as my grandfather, who had an 8th grade education, used to say, and I think he was a lot more savvy about financial matters than these Wall Street wizards, he used to say, when you're paying interest on interest, you have a problem.
Right.
And that's what these guys are doing. They're paying interest on interest, right?
That's exactly what they're doing.
Yeah. And that can only go on for so long. And then the thing has to blow up. I mean, how else can it possibly end here? So is this it? Or do they get a little bit more mileage out of it? Bill, that's really the question.
Well, I was asked yesterday, what my opinion is. What are the odds of something happening and the end of the road being in 2015? My guess is it's probably a 60 or 70% chance that the end of the road is here in 2015.
I couldn't agree more. So many forecasters are predicting it. Martin Armstrong, among others, Sovereign, Big Bang. I just don't see any way out of it. Do you?
There's no way mathematically out of where we're going. The money's been borrowed, the money's been printed, and there's not enough, quote, money beneath it to carry it. The collateral's gone. Everything has been borrowed against.
Mm-hmm. And so is this a case of the debtor owning the bank, or the bank owning the debtor, or basically they're both bust? They're both bust.
Yeah. That's my opinion. I think it's a start over moment, and those who have the gold will more or less be bankers. They will have the capital. It will be levered upon to get the system started again.
Mm. And
how long that takes, I couldn't tell you.
That was going to be my next question. How long is that going to take? Reading my mind again.
My guess is it's going to take at least 3 months.
Yeah. And we're going to have total chaos and social unrest and all the things that you just don't want to think about are going to take place during that time, aren't they?
I did an interview yesterday, and this was one of the topics. Think about this. There's 48 or 50 million people on food stamps right now.
Mm.
So, no, you don't see bread lines like you saw in the 1930s, but there are bread lines.
Virtual.
Virtual bread lines. It's about 15% of the population. When this comes to pass, do you think those people have food stocked up? No, they don't.
They're living hand to mouth.
Right. You're going to have 48 to 50 million people just on food stamps alone that are going to be out in the streets looking for food.
Mm-hmm.
How's that going to be handled? I mean, that's complete chaos, and we've seen it. Just look at some of the rioting we've had in this past year.
Right. Yes.
You could take that and multiply it by exponentially multiply it. That was a few thousand people. This is going to be millions of people, and it's going to be all over the world. It's not going to be just in the U.S. because the dollar is the reserve currency for 60%, 70% of the world's other central banks. I mean, I used to live in Costa Rica. Their reserves to the central bank are 100% U.S. dollars.
Yep, it's
so what's going to happen there? The banks are going to close.
Mm-hmm.
And when the banks close, there's no distribution. When there's no distribution, the shelves don't get restocked up.
Hey.
So, there might be 3 days worth of food, and that's it.
Let's not forget where the bulk of the world's corn exports come from, soybeans, so many things that the breakdown of U.S. distribution system really, as a practical matter, can't be allowed to happen. So they're going to have to think of something really quick if they haven't already. Can't be allowed.
So because everything runs on credit.
Yeah, you got
the
it.
loaf of bread that you get at the store, there was credit used probably 5 or 6 times or more to get that loaf of bread that costs, $1.50 or whatever it is. There's credit used
to fill your tank.
Yeah, exactly.
Right?
For anything and everything you consume, there's at least 5 or 6 steps of credit use.
Mm-hmm.
And if credit seizes up, and all you need is one of those steps to break down, and the product doesn't get to market. And what's going to happen is all of those steps are going to break down.
Yeah. Well, let's not think about that now. Hopefully somebody somewhere is grown up, has a plan to float another system before it happens. What's his name? Jim Rickards seems to think the system's already in place and they just need to flick a switch, and SDR land, here we come. I don't know if that's true, but anyway, Bill, hey, it's really good to catch up with you. Find Bill's work, milesfranklin.com, subscribe to his daily missive along with our good friend Andrew Hoffman's. And hey, while you're at it, come over to financialsurvivalnetwork.com. Check out the site. We've got Bill's work, Andy's, and so much more from all over the world. We're keeping you abreast of the situation as it unfolds, unlike your mainstream media. And sign up for the free newsletter while you're at it. Bill, we will talk with you again real soon. It's getting interesting.
Look forward to it.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.